Bitcoin's 25-day liquidity window has already begun, and most investors still see nothing more than a sideways range. That's the story on the surface, but the deeper story, the one that actually moves markets, starts now. Because inside this window, the Fed, the Bank of Japan, and US regulators are all preparing decisions that can shift Bitcoin's liquidity backdrop far more aggressively than any single candle on your chart. So I hope you can see the bigger picture. This isn't about short-term volatility. This is about liquidity structure. When liquidity changes direction, Bitcoin responds, and often earlier and faster than traditional assets. So by the end of this video, you'll understand why these next 25 days matter and how each macro event fits in together. And most importantly, how to position with more clarity instead of reacting to noise. But before we look forward, we need to understand where Bitcoin truly stands today, because the headlines capture the fear, yet missed the structure beneath it. So without further ado, let's get started. We know that Bitcoin just completed a 36% correction, the sharpest of the cycle, yet fully aligned with the pattern seen in previous bull markets. Cycles breathe, remember that. They expand, reset, and continue. And this reset fits that previous rhythm. But here is where the picture gets more interesting. On-chain data shows that long-term holders, the group least likely to panic, sold heavily into the decline. Their supply dropped to roughly 14.33 million Bitcoin in November, the lowest level since March, which raises a question. If the patient holders have already taken profits, who is left to sell aggressively? That's one reason the probability of additional forced selling looks significantly lower now. And price structure reinforces the same conclusion. Bitcoin, we see, responded precisely at the 88 to 89,000 fair value gap, a zone created by a prior fast move that left unfinished business behind. Markets almost always revisit these pockets, and this one did. It filled. Buyers stepped in. Liquidity confirmed the level. From there, the price pushed back towards $92,000, testing the downtrend that had been in place since late October. Breaking it matters, but what sits beneath it matters even more, because retail participation has fallen sharply, is what we've seen. Search interest is down, social engagement is down, trading volume muted. A quiet market is a sensitive market, and sensitivity to macro catalyst is exactly what defines this 25-day window. That is the backdrop. And now we layer the macro calendar on top of it. The Federal Reserve meets on December 9th through the 10th. And while the market expects a 25 basis point cut, the real story isn't the rate decision itself. It's the trio of signals that surround it: the policy statement, the forward projections, and Powell's tone of voice at the press conference. People will be reading in to the nuance in his delivery. And when volatility is compressed and order books are thin, as they are now, even one unexpected phrase can move Bitcoin more than usual. So the question becomes, what does the Fed reveal about its policy path and liquidity conditions as we move into 2026? Will it be faster rate cuts, slower cuts, balance sheet adjustments? Any shift in guidance becomes a spark. And right now, the market is dry grass. And this is the first checkpoint. But the next one is less discussed and often underestimated. And by that, I mean the Bank of Japan meets on December 18th and the 19th, with reports indicating a potential rate increase. For a country emerging from years of negative rates, this is not a small adjustment. It's an entire structural pivot. When Japanese yields rise, capital often flows back home, and that can push up US yields. It can strengthen the dollar and tighten conditions globally. a combination that tends to weigh on risk assets. But then, add this in, US layoff data is accelerating, approaching levels last seen during the global financial crisis. Rising layoffs increase political and economic pressure for policymakers to support growth. So, we have a Fed approaching cuts, a Japan considering hikes, and a US labor market softening. Together, these forces shape the liquidity environment the market will face as it moves into 2026. And now we arrive at the third catalyst, the regulatory shift that could open the door for institutional scale. And recently, the SEC chair, Paul Atkins, said on CNBC that they are working on a Bitcoin and crypto market structure bill with a roughly 25-day timeline to push it through. Market structure may sound technical, but in practice, it decides who is allowed to trade these assets, how are they custodied, which venues are legal, and how traditional institutions can plug into all of that. For big banks, pensions, and asset managers, this matters more than the intraday price on Binance. They need rules, plumbing, and clear lanes before they can size up. Meanwhile, Wall Street is building. BlackRock filed another crypto ETF prospectus, big word, I know, but this time for a staked Ethereum ETF, adding to their spot Bitcoin ETF, spot Ethereum ETF, and Bitcoin income product. Corporations are acting too. Michael Saylor, recently under fire, poor thing, reported meetings with banks, sovereign wealth funds, and fund managers about Bitcoin's strategy. And shortly after, MicroStrategy disclosed a purchase of 10,624 Bitcoin for roughly $962.7 million at an average price near 90,615 per coin. And sovereign interest is emerging as well from countries. Argentina's central bank, for instance, is considering rules that would allow commercial banks to offer Bitcoin services directly and individually. These headlines perhaps seem scattered, but together, when you combine them, they form a clear pattern. Institutions are positioning themselves ahead of clarity, not waiting for it. But now let's look at the force ultimately driving all of this, and that is liquidity. The US M2 money supply recently reached a record of $22.3 trillion, a meaningful rise in system-wide liquidity. And historically, when M2 expands and the Fed cuts rates, Bitcoin tends to outperform. We saw this in 2020 through 2021 when Bitcoin climbed from under $10,000 to above $60,000 per Bitcoin. And looking ahead, analysts at firms like UBS expect the Fed to purchase between $40 and $45 billion of Treasury bills per month next year in 2026 as part of their reserve management operations. And Bank of America charts the same trajectory, with bill purchases rising through 2026 via various balance sheet programs. We've also seen this dynamic before. In 2019, the Fed ended quantitative tightening. The repo market broke and T-bill purchases surged. Before COVID hit, equities rallied double digits and Bitcoin gained roughly 200% from its lows. Incredible. And today, quantitative tightening is slowing. Thank goodness. M2 is rising, layoffs are increasing, and policymakers are shifting their tone of voice. The rhythm is hard to miss. So when we talk about a 25-day liquidity countdown, it's not just about the Fed and Bank of Japan's statements this month. It's about the path that leads into a broader liquidity cycle into and throughout 2026. Now let's examine where liquidity is sitting inside the crypto ecosystem itself. USDT dominance is pressing into a peak zone that previously has preceded major altcoin rotations or pumps. We saw 110% in 2024, and earlier this year, 160%. A large portion of capital is still sitting in stablecoins. So it's not gone, it's just waiting. Retail interest remains quiet too. Searches are lower, volume is lighter, and order books are thin. This creates an asymmetrical setup, a market that has reset, deleveraged, and stabilized, while significant capital waits for a catalyst. Meanwhile, institutions are preparing, as should you, as should we. Corporations are buying, sovereign nations are exploring integration, and regulatory clarity is approaching. So the setup is straightforward: low retail noise, stabilized structure, and high sensitivity to liquidity shifts. This window may not define the next 2 years all on its own, but it can flip the narrative. And once the narrative shifts, flows typically follow. So here's the bottom line. Bitcoin just went through a normal, healthy cycle correction with a lot of probable manipulation from the greater forces in the world. However, over the next 25 days, three major macro events all converge, happen at the same time. On the one hand, we have the Fed's guidance coming out. Next, we have Japan's rate decision also to be announced. And we have the SEC's market structure timeline. And behind all of this, the money pool is expanding. M2 at $22.3 trillion. Plans for tens of billions of dollars per month in Treasury bill buying in 2026, and a labor market that pushes policymakers towards easing. In previous cycles, this kind of a liquidity shift has aligned with some of Bitcoin's biggest upside or pumping. Inside crypto, stablecoin dominance sits in a zone that previously came right before huge altcoin rallies, all while retail interest is still low and institutions are quietly accumulating. So as this countdown unfolds, which is what is happening, track how Bitcoin reacts around the Fed and Bank of Japan's decision announcement, whether the SEC bill advances, and whether ETF flows and on-chain activity pick up. Use that as your scoreboard instead of every $1,000 swing up or down. So if today's video brought you clarity, like the video, subscribe, turn on the notification bell so you do not miss my next video, as I do put a ton of work into each video, as does my team. My wish for you is that you stay informed, stay ready, and stay steady. And that most importantly, you be on the right side of this liquidity cycle. I love you guys so much. That's a wrap for today's video, and I will catch you guys here tomorrow. Take care.